There is a pattern in financial history that has reshaped four of the world's largest economies in the last 35 years. And right now, the United States is moving through that same pattern almost line by line, as if the script was written long before anyone realized they were following it. In 1990, Japan was the engine of global growth. Its markets were unstoppable, its corporations dominated entire industries, and its asset values were the highest on Earth. Within a few years, the momentum vanished. A debt-fueled boom turned into a decades-long stagnation Japan has never fully escaped. In 2011, Europe, armed with the euro and backed by the largest economic bloc on the planet, hit the same invisible wall. Yields broke loose, governments strained, and the continent found itself locked inside a financial structure it could not outrun. China entered the same zone in the 2020s. After years of building, lending, and expanding faster than any country in modern history. And now the United States is beginning to feel the same pressure beneath its foundations. Subtle, familiar, and unmistakable. Every major financial cycle begins the same way. The surface looks calm. Markets push upward. Credit expands faster than output. Confidence grows so naturally that no one questions it. The momentum becomes its own justification. Growth feels structural, permanent, inevitable. And because everything seems to work, the system keeps pushing forward, unaware that it's crossing a threshold where each additional unit of debt produces less real return. Nothing crashes right away. Nothing screams warning. But beneath the surface, the friction starts building slowly, steadily, relentlessly. Japan reached that threshold first. In the late 1980s, its wealth seemed limitless. Land under the imperial palace was valued higher than all of California. Europe followed, but with a different architecture and a sharper edge. The euro was designed to unify, but its structure hid an imbalance. One currency, dozens of fiscal realities. For years, markets priced all European sovereign debt as if they were equal. That illusion collapsed when Greece revealed its true deficits. Yields exploded. Italy's borrowing costs surged. Portugal and Spain strained under refinancing pressure. None of these nations suddenly became weaker. What changed was the price of trust. When refinancing becomes fragile, debt becomes heavy. Europe stabilized only when the European Central Bank committed to doing whatever it takes. But the damage was already structural. The continent lost the forward momentum that had defined the early Euro years. Growth slowed. Demographics worsened. The system survived, but it calcified. China's rise looked nothing like Japan or Europe on the surface, yet underneath, the mechanics were identical. For 2 decades, China built faster than any economy in history. Entire cities rose before they had residents. Local governments borrowed through opaque financing vehicles. Developers pre-sold millions of units before pouring the foundations. The model worked as long as property values rose and demographics supplied endless demand. But momentum is a finite resource. By the early 2020s, population growth faltered, household formation slowed, and the leverage supporting the construction boom began to strain. Evergrande's collapse wasn't an isolated failure. It was the visible crack in a structure carrying far more weight than it could sustain. China didn't crash. It slowed hard. And the slowdown wasn't a temporary cycle. It was the unmistakable sign of an economy entering the upper arc of its debt supercycle, the point where additional credit no longer buys additional speed. Across all 3 cases, the surface narrative looks different: Japan's asset bubble, Europe's sovereign crisis, China's property stall, but the internal movement is identical. Credit expands to fuel growth. Growth depends on that credit. Productivity stops keeping pace. Then the entire system becomes sensitive to even minor tightening, minor shocks, minor liquidity shifts. This is the moment when economies don't break, they stiffen. They become heavier. They require more support to maintain the same baseline. The real shift is invisible to the public because it happens in balance sheets, funding structures, rollover schedules, and demographic curves, not in headlines. Which brings the pattern forward to the United States. The numbers are different, the institutions are different, but the trajectory echoes the same arc. Over the last 2 decades, federal debt has grown faster than the real economy. Interest payments surpass $1 trillion. Rollover volumes climb as maturities shorten. Growth remains positive, but the leverage underneath grows faster than the output it produces. Market reactions to liquidity changes become sharper and more immediate. Each tightening cycle exposes how dependent the system has become on low funding costs and constant capital flow. Each easing cycle reinforces that dependency. Nothing here signals collapse. What it signals is saturation, the same saturation Japan hit in 1990, Europe in 2011, and China in the early 2020s. A point where the old engine still runs, but no longer accelerates. A point where the past becomes heavy. A point where debt isn't a crisis, but a gravitational force. A point where every major economy in the pattern starts to look the same, even if their stories look different. The United States isn't repeating Japan, Europe, or China. It's repeating the mechanism underneath them. A slow, quiet shift in the debt supercycle that only becomes obvious when the momentum is already gone. The pattern is simple: expansion, saturation, stagnation. The timeline is different each time, but the movement is the same. And once an economy enters that zone, the change doesn't arrive with drama. It arrives with resistance growth that feels heavier, cycles that feel shorter, markets that feel more fragile even when they look strong. Looking backward, the symmetry is unmistakable. Japan drifted for decades. Europe lost its acceleration, China's momentum thinned. And the United States now presses into the same invisible threshold slowly, silently, predictably. Different nations. Different eras. Same hidden reset. When you trace the hidden arc of excessive leverage through the last century, the Soviet Union becomes the starkest reminder of what happens when an economic system keeps pushing long after its internal engine has already lost thrust. The USSR didn't fall in 1991 because the state weakened suddenly. It fell because the financial and industrial structure beneath it had been grinding down for years, absorbing stress in silence until it could no longer carry the weight. By the late 1970s, Moscow was running one of the largest military machines in human history. Defense spending consumed an estimated 15 to 20% of GDP. The country projected power across Eastern Europe, Africa, the Middle East, and Afghanistan. To an outside observer, the superpower looked immovable. But inside the system, something critical had changed. Productivity had stalled. Oil revenues, which had once supported aggressive expansion, began fluctuating. Industrial output lost momentum. And the planned economy, which had always depended on centralized allocation, could no longer generate enough real surplus to support both civilian life and its global commitments. The problem wasn't ideology, it was arithmetic. When an economy spends more maintaining its position than it earns through productive output, the structure begins feeding on itself. The USSR compensated by extracting more from its satellite states, redirecting resources, and borrowing externally. But these moves only bought time. By the mid-1980s, the pressure became visible. Shelves emptied. Factories lagged. Infrastructure decayed. And when oil prices collapsed in 1986, one of the system's few lifelines snapped almost overnight. This wasn't a dramatic explosion, it was a slow suffocation. The Berlin Wall fell in 1989, not because of a sudden loss of military strength, but because the economic foundation holding the system together could no longer support the weight of its obligations. Between 1989 and 1991, the Soviet structure compressed in a span of roughly 900 days. Not a collapse of ideology, a collapse of capacity. A superpower undone not by an enemy, but by the compounded weight of decades of financial strain. That same hidden pressure debt running ahead of output. Obligations running ahead of resources now shapes how the United States moves through its own moment. The surface narrative looks nothing like the Soviet Union. The institutions, the markets, the currency, the democratic structure, everything is different. But the mechanics underneath big systems follow patterns that are surprisingly consistent. Excess leverage always changes the way an economy reacts to stress. Look closely, and the first sign is already visible. Expansion that depends on credit rather than productivity. For years, U.S. growth has leaned increasingly on borrowing rather than output gains. Corporate debt, household debt, and federal debt have all expanded faster than real economic capacity. This isn't unusual. Every advanced economy goes through a phase where credit grows faster than GDP. The trouble begins when the pace stops reversing. When the debt curve outruns productivity long enough, the system becomes dependent on continued borrowing just to sustain its baseline. The second pressure point appears in the cost of money itself. Interest payments that once occupied a stable share of federal spending have surged past $1 trillion. This isn't because the system is failing, But because the accumulated weight of prior borrowing has reached a point where even small changes in rates push total costs sharply higher. When an economy begins devoting more energy to servicing its past than investing in its future, momentum naturally slows. Growth becomes heavier, cycles become more fragile. The third sign emerges in how markets respond to liquidity shifts. During earlier decades, U.S. markets absorbed tightening phases without dramatic reactions. But as leverage expanded, the system became more sensitive. Liquidity drains that once caused minor ripples now create immediate strain. Small policy changes generate large market movements. Funding markets react faster. Volatility spikes earlier. These reactions don't mean collapse. They mean saturation, the point where leverage magnifies every fluctuation. The fourth marker shows up in the underlying productivity trend. Output per worker in the United States has decelerated across multiple expansion cycles. This matters because productivity is the only long-term anchor for real growth. When it flattens while debt keeps climbing, the system quietly shifts into the same zone. Japan entered in 1990 and Europe entered in 2011, a place where new credit produces diminishing returns. This is the silent drag at the heart of every mature debt cycle. Nothing breaks, but everything slows. A fifth pressure can be seen in fiscal inertia. Deficits used to expand only during recessions. Today they persist even during strong years. This isn't political, it's structural. When a system carries heavy legacy obligations, entitlements, interest payments, essential services, reducing spending becomes nearly impossible. The past becomes a fixed cost. The economy grows around it, but the weight remains. And because debt amplifies each future cycle, the baseline pressure ratchets upward quietly. A sixth point appears in the reserve structure of the global system. The US dollar remains dominant far more than any currency in modern history. But reserve dominance doesn't prevent strain. It absorbs it. When global conditions tighten, dollar demand spikes, stressing foreign economies first, then feeding back into US funding markets. The structure still works. It's still stable. But the sensitivity is higher, the margins are thinner, and the system reacts faster to the very imbalances it once dampened. None of these signals imply crisis. What they imply is phase, the same phase Japan entered after its boom. Europe entered after its sovereign shock, China entered after its construction peak, and the Soviet Union entered in its final decade, the point where prior expansions create a gravitational pull. A point where weight accumulates faster than momentum. A point where the system is still powerful, still functional, still leading the world, but less flexible than before. This is how large economies move through long cycles. Not through sudden breaks, but through slow shifts in texture. Growth becomes harder. Stability requires more intervention. Liquidity matters more. Policy mistakes cost more. And the economy begins to behave like a machine with too much friction inside, not broken, just resistant. When you compare the trajectories, the parallels aren't about ideology, geography, or governance. They're about physics. Leverage changes the way systems move. Debt shapes the way economies age. Momentum carries a cost. And every major power eventually confronts the moment when its past weighs more than its present can fully accelerate. Japan learned it through stagnation. Europe learned it through structural strain. China is learning it through the cooling of its most important engine. The Soviet Union learned it through collapse, but collapse was only the surface expression of an imbalance that had been building for years. And the United States now steps into its own version of that same invisible threshold. Not a repeat of anyone else's story, a repeat of the mechanism beneath all of them. The truth is simple: large systems don't fail when the world is watching. They shift long before the world notices. They absorb stress silently. They stretch, accommodate, and adjust until the accumulated friction becomes permanent. And by the time the pattern is obvious, the transformation has already happened. This isn't a prophecy, it isn't a warning, it isn't a forecast. It's the same quiet progression that has shaped every great economic power over time. A pattern of expansion, saturation, and slowdown playing out again inside the largest economy on Earth. Not because history repeats, because leverage does.